Welcome to Core Finance, where I'm joined by Campbell, who's a financial analyst at Spreadex. How today, Connor?
Very good, thank you.
Okay, let's get straight into the markets, starting off with Campbell.
Yeah, it's managed to hold above 130 for a bit of time. It bounced below that last week, but has managed to climb above that. It seems to be where it's likely to settle at the moment. This week, obviously, big week. You got the UK GDP on Wednesday, US GDP on Friday, and most importantly, the Fed meeting on Wednesday. A lot of, I guess, the hard work has been done by the Fed already. It's sent enough sort of dovish messages out there that nothing on Wednesday really should come as a surprise. And that's been responsible for the dollar's sort of miserable summer performance really against both the pound and the euro. I think the only danger is perhaps for the pound that if the Fed now isn't as dovish as expected, if there's even the slightest hawkish hint among the notes from the meeting, then that could be a huge boost to the dollar just because it has flagged so much in the last few weeks. I think that's why we've seen from our clients incredibly mixed trading around Campbell at the moment. There are plenty of sellers around that 130 mark, but there are enough buyers to keep it above that level. So I really do think it's going to be down to the minutiae of what the Fed says on Wednesday evening.
Okay.
FTSE, again, it's mixed, but in a fairly clear way. Like whenever it's below 7,400, we've seen a fair amount of buyers. But the moment it crosses that level, like this morning, we're seeing more and more sellers come in. It's got sort of an absurdly busy second half of the week. I think 23 of its companies are reporting between Wednesday and Friday, that's too many basically. I think it might, unless somehow there is a general trend among all of those 23 companies, which, considering it's from a variety of different sectors, etc., I'm not sure if there'll be that. The FTSE may struggle to really do much this week. It may continue to loiter around that 7,400 mark, and what side of it sits will be dependent, I guess, on the likes of Barclays and Lloyds and the miners, I guess, that are reporting this week. And then you've got things, also big stocks like Shell, British American Tobacco. There's just basically too many stocks to really get a handle on what the FTSE is going to do.
So throwing everything up in the air.
Yeah, exactly. It's going to be too hard. I think you'll see so many things cancelling each other out unless there is some real shockers that drag it down, basically. So I think that's why we're seeing our clients overall leaving it around that 7,400 mark.
Okay.
ITV, one of those companies reporting this week, sort of had a horrendous last few months, really. The departure of Adam Crozier, then its first quarter figures back in May. I think revenue fell 3%. Advertising revenue was down 9%. ITV largely blamed the lack of sort of summer football. Last summer it had the Euro 2016. This summer it hasn't got that comparatively huge, boost to marketing revenue, but advertising revenue. But at the same time, there's also, advertising revenue has shrunk since Brexit. That could be a continuing issue for ITV going forwards. One bright spot in that was the 7% rise in revenue at ITV Studios. I think that is going to, in the next few years, become increasingly important for ITV. It's another source of revenue that isn't reliant on ads, and it leaves them a bit more in control of their output, really.
Because so content creation is
exactly, create enough shows that you can sell to Netflix, and that's a nice little buffer, really. It's going to be a bit of an odd half-year report because it's post Adam Crozier, basically, but then before Caroline McCall takes over in January. So it's sort of this weird
power vacuum.
Yeah, exactly. Where I don't think ITV are going to want to,
say too much.
Yeah, ruffle too many feathers before McCall can come in and sort of create her own, her own start to her own era. So I think it's really going to be, if there's the slightest lift on, I think analysts are expecting an 8 to 9% fall in advertising revenue. If that's slightly better than expected, then it's looking so dogged at the moment that the slightest bit of good news is going to lift it towards the £1.80 mark, basically.
Okay.
Just Eat is sort of the kind of company that's figures are sort of absurd. The headline figures are absurd. I think its full year figures back in March, there was a 164% increase in pre-tax profit to just over 90 million. First quarter figures then in May, that you had a 46% increase in revenue, a 40% rise in like-for-like sales, and then things like a 38% rise in international sales, I think due to Skip the Dishes, which is like a Canadian company, I think the Canadian equivalent basically, that's given it a foothold in North America. Other issues, you've got a bit disappointing for Just Eat that the £200 million takeover of Hungry House seems to have hit a stall basically because the CMA are going to do a more in-depth investigation, which makes sense, because that that is its main bar stuff like delivering that, which I still don't think has got the same, dominance as Just Eat. You wipe out Hungry House and Just Eat's looking pretty greedy there. So I can see why that has been stalled a bit. But its figures are so strong, those headline figures are so strong, I think it will take a significant miss really to distract from, any revenue up 50% is always going to be attractive to investors. So our clients have been buying around that £7 mark, even if it just looks to creep back towards the 7.20 mark. It doesn't have to massively increase on its all-time highs. I think our clients are just happy with where it's at the moment.
Okay.
BT, you can see at the start of the year, it's just sort of its year's been defined by that Italian accounting scandal, and it hasn't really been able to find anything since then to convince investors to get back on board. The only thing I'll say is, I guess it's its first quarter report this week on Friday. The company, I guess, will be hoping it can, put all the Italian accounting scandal behind it, put the ongoing Openreach issue that now seems to be sorted. It's now under a rebranding, which is basically them spending millions of pounds just taking the words BT off of all their vans. Beyond that, I imagine they're going to try and strike a positive note on Friday, try and mean that, this is a new year, new financial year, everything's in the background. They got a lot of bad news out of the way with its fourth quarter report, it announced it was cutting 4,000 jobs. The only thing is, investors haven't really been convinced so far with any of the stuff they've produced, and I'm not sure. I think sales are meant to be flat, earnings are meant to be flat. I think pre-tax profit is meant to be up nearly 5%, but that's thanks to Openreach. So that's always the fact that is their biggest sector, and that's forcibly being removed out of their hands a bit. Doesn't paint the best picture for the rest of BT's business. So we'll see. The only thing is, it is looking a bit like ITV, a bit dogged. It has risen, I guess, in the last few weeks. That means it might not have too much room to rise, but our clients are still buying it just above that £3 mark, even if it just loiters or crawls back to the 3.10 mark.
You've seen the dips to £3 have tended to be below £3 have tended to be bought into, so
yeah,
seems to be a bottom fishing situation. But we shall see. On that note, Campbell, financial analyst at Spreadex. Thanks for coming in.
Thanks very much.